Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at PRTA, or Prothena Corporation. PRTA is a biotechnology company focused on the discovery and development of therapeutic monoclonal antibodies for disease-causing proteins. Here's the barchart.com technical opinion for PRTA. The bar chart technical opinion rating is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that PRTA is well above the moving average line, so the monthly trend in PRTA is up. Next, we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since at least February, so the daily trend is up. Since the monthly and daily trends are both up, PRTA is on our buy list. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel, or even below the Keltner channel, is fine. The PRTA stock price is below the upper Keltner channel line, so PRTA is inside the buy zone. Since the trend is up, we want to buy a call. PRTA has 8 option chains to choose from. We're going to use the September 17 option chain. Right now, the September 17 options have 25 days to expiration. Here's most of the PRTA option chain for September 17. PRTA closed at 59.82 on Friday. That means any calls on the list from 55 to 33 are in the money. Let's take a look at the profit potential for purchasing the PRTA 60 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 60 call is 350 to 650. We try to enter at the midpoint, so we'll use 5 even as the buy price. Call option calculator shows the profit potential for this call based on PRTA price changes and at option expiration from flat to a 12.5% increase in price. We can see that if the PRTA stock price is flat at 59.82 at option expiration, the 60 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means that the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's look at buying the 50 strike call to see if it qualifies for the 1% rule. Here is the call option calculator picture for the 50 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculated picture shows that if the PRTA stock price is up 1%, the 50 call will lose 9.4% of its value. We want that to be break even or better, so the 50 call does not meet our requirements. Let's see if the 40 call will work. The bid-ask spread for the 40 call is 18 to 22.50. We try to enter at the midpoint, so we use 20.25 as the buy price. The 40 call works If the PRTA stock price is up 1%, the 40 call will make a 0.8% or $17 profit. That's better than break even, so the 40 call is the one we'll buy. The call option purchase calculator also shows that if the PRTA stock price increases by 2.5%, the 40 call will make a 5.3% or $107 profit. If the PRTA stock price increases by 5%, the 40 call will make a 12.6% or $256 profit. If the PRTA stock price increases by 7.5%, the 40 call will make a 20% or $406 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the PRTA stock price does not make the expected move up and remains flat at expiration, the 40 call would only lose minus 2.1% or minus $43 compared to the 91.6% or $458 loss for the 60 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the PRTA September 17 expiration 45 strike call and sell to open the PRTA September 17 expiration 55 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 45 call for $15.75 and sell the 55 call for $8.25. $15.75 minus $8.25 equals $7.50. So the entry price or debit cost for the spread is $750. Our call option spread analysis calculator picture shows that the spread will make a 33.3% or $250 profit if the PRTA stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect an $825 credit to our brokerage account for the sale of the 55 call. As we said on the previous slide, this reduces the cost of entering the spread to $750. Here is a note regarding earnings reports. The next PRTA earnings report is scheduled for November 4. Let's review the trades one more time. First trade was a call purchase. It said to buy to open the PRTA September 17 expiration 40 strike call for 2025. We also reviewed a spread. Spread said to buy to open the PRTA September 17 expiration 45 strike call and sell to open the PRTA September 17 expiration 55 strike call at a debit of $750. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.